So now let's talk about the cost of capital. Again, a very important topic as far as financial management concerned. It is the minimum required rate of return on the funds committed to the project. It depends on the riskiness of its cash flows. For example, when company in the previous chapters we have seen the different sources of finance that company requires. So they may either go for a short-term source of finance or medium-term or long-term, or in case of other forms, either own capital or borrowed capital, or internal source or external source of finance. Whatever may be the fund, for each fund, certain cost is involved. So no fund is at free of cost for the company. For each and every source of capital, they have to pay certain cost. So, for example, in case of equity, if company wants to mobilize the fund in the form of equity, for that a certain cost have to be paid by the company. That is called as the cost of that particular equity capital. So the company may either go for only equity, or they can go for they can leverage their what is called a source of finance in the form of debt also. The combination of both debt and equity, they can go ahead. So what they can do is if they want to go for both equity as well as a debt, or any only equity alone, then they have to find out what is the total cost of capital that a company is supposed to pay. For example, if company is depending on only equity, then the cost of equity I will assume that if it's a 10%, then the weighted average cost of capital also it's like a more of the same, because they have only one source of capital called as the cost of equity. Suppose if they follow up both the debt also, then if they have used a debt fund also as a source of finance, then they have to calculate cost of equity separately, then cost of debt separately, then the combination of all these together, they calculate in the form of WACC, that is weighted average cost of capital. If the weighted average cost of capital, that is the cost, how much they are going to pay for each and every capital which they have mobilized, assume that it's 11%. Then the cost of capital is nothing but it's the minimum required rate of return on the funds committed to the project, which depends on the riskiness of its cash flow. So, which means from the investment, they have to mobilize minimum the 11%. That is the 11% of the cost which they are going to pay for the equity as well as the debt. So the minimum required rate of return on the funds committed to the project. So from the project or from the investment, or whatever money that is invested in the business, from that they have to get that minimum 11% return. Then only the company can achieve the status of a break even, no profit, no loss situation. The cost equal to the return of the particular company. And why it's significant, why we need to study about cost of capital is the reason is it's helpful in evaluating the investment proposals. So, for example, a company wants to go ahead for purchasing a what do you call as an automatic machine, or if they want to set up what do you call as a new factory, or if they want to expand their business, whatever may be the investment purpose, or if they want to buy a new company, or if they want to replace their entire what do you call it as obsolete assets, or if they want to what do you call it as modernize their business, whatever may be the investment proposals, money is involved, the source fund is involved. So they have to mobilize fund from any of the again the same sources only. So then they have to look after the cost for each and every source of capital, and finally the evaluation of investment decision will be made by the finance manager. And more of the next thing is it's helpful in designing a firm's debt policy. For example, if company follows a debt policy of 30%, which means whatever money fund or the finance required by the company, only 30% they will be getting from what you call as the debt. Remaining 70% they want to stick with the equity. So if the cost is more, then they have to reframe the debt policy. So that is why this cost of capital plays a major role in reframing or designing the firm's debt policy. Then it's helpful in the appraising the financial performance of top management, because they need to find out a proper or appropriate mix of debt and equity. So the next thing is what are the different components of cost of capital. So here, for example, the different components of cost of capital includes what is that is a one source of finance is called the debt. What is the cost involved in that is cost of debt. Then another source is preference share. What are the costs involved for acquiring the preference share or preferred capital is cost of preference share. The next one is the cost of equity share. The next one is cost of retained earnings. And altogether, the overall we can find out weighted average cost of capital, that is WSCC, or overall cost of capital or composite cost of capital. So these are all about the different components of cost of capital. So next we'll see about the significance or importance of cost of capital. So this cost of capital is very important for a company point of view, as I explained in the previous slides. So it helps in the maximization of the value of the firm. It helps in the capital budgeting decisions. It helps in decisions regarding leasing, and it helps in the management of working capital, and it helps in the dividend decision. Again, another very important decision the finance manager takes in the four functional areas, that is the dividend decision, and again in determining the capital structure of a company. So this cost of capital plays a major role, and also it helps in the evaluation of the overall financial performance of a company. For example, in case of how it maximizes the financial or the value of a company. For example, a firm tries to minimize the average cost of capital, suppose. So then the purpose of maximizing the value of the company is nothing but when it minimizes the cost. When it minimizes the cost, automatically the value of the company or value of the firm it increases. So there should be a like a judicious mix of debt and equity in the capital structure of a company. So, for example, they should not depend more on equity or they should not depend more on debt. There should be an optimal capital structure mix should be there. That should be followed by the company so that the value of the firm can be maximized. And this helps in capital budgeting decisions also. So, for example, proper estimate of cost of capital is important for the company point of view in taking the capital budgeting decision. Generally, the cost of capital is the discount rate for used for evaluating the desirability of the investment proposals. So, for example, in the internal rate of return method, the project will be accepted if the rate of return is greater than the cost of capital. So, the return should be more than the cost. So, then automatically the particular project or particular investment or what you call as the proposal will be accepted. So then, even in calculating the NPV, what we do is the expected future cash flows from the project. The cost of capital is the needed for discounting. So why it's used is even in NPV calculation, it is used for discounting by what you call as the future cash inflows will be discounted to the present cash inflows. So thus for this cost of capital acts as a very important one as far as the firm's what you call as the capital budgeting decisions as well as even other decisions also. The next, it's very important in case of deciding about the leasing, whether the company can go over with the leasing or whether they can purchase. It all depends on the cost of capital as well as the what do you call it as the company's financial structure. The next one is management of working capital. So here all the four financial decisions have come in case of what do you call it as the cost of capital is concerned. For example, in case of investment decision or dividend decision or capital structure decision or working capital decisions, whatever it may be, all the four financial decisions of a company depends on the cost of capital. So even for example, in management of working capital, the cost of capital is used for calculating the cost of carrying the investments in receivables and used to evaluate alternate policies regarding the receivables. It is also used in what we call as the management of inventory also. So this cost plays a major role there in inventory management as well as the receivables management too, in deciding whether to go forward with the investment or not. Then dividend decision. So this cost of capital is very important for dividend decision is concerned. The dividend policy of the firm should be formulated according to the nature of the firm, whether it is a growth firm, normal firm, or declining firm. However, the nature of the firm is determined by comparing the internal rate of return with the cost of T, or we call it as cost of capital. So normally, in even in the relevance theory of dividend, we calculate the what do you call it as then we will come to a conclusion that whether the company is a normal firm or growth firm or what do you call it as the stable firm. So how we calculate is based on, for example, if R is greater than K, then we call that is a growth firm. If R equal to K, we call that as the normal firm. If R less than K, then we call that as the declining firm. So R means rate of return, K means cost of capital. So when return is more than the cost, then we call that company as a growth firm. So that's why this cost of capital plays a major role in dividend decision also. Then determining the capital structure. In determining the capital structure, we know the meaning that it's a mix of debt and equity. And company requires a fund, they have to decide how much they can get from equity and how much they can get from what you call it as the debt. Okay, equity as well as the debt. The proportion they need to finalize. Okay, this mix plays a major role in deciding the company's performance. So this determination of capital structure, that is how much to go for equity, how much to go for debt, also that is very important in case of company point of view, and that is decided by the cost of capital. Cost of capital plays a major role in deciding the capital structure of a company also, and it's helpful in evaluation of financial performance. For example, this is used to evaluate the financial performance of top management, and by comparing the actual profitability of the investment project undertaken by the firm with the overall cost of capital. So the top performance management performance can also be evaluated with the help of cost of capital. Whether the management have taken the right decision or not, whether they have followed the optimal capital mix or not, all these things can be judged with the help of cost of capital. So now we'll see about factors determining the cost of capital. The following are the different factors that contribute to or that determines the cost of capital. The first one is general economic conditions, then market conditions, the firm's operating and financing decisions, and the amount of financing required. So these are the four factors that determine the cost of capital. So in case of general economic conditions, so the demand and supply, so that plays a major role in what do you call it as the determining the demand and supply of the particular capital, and like what is the inflation rate. All these things plays a major role in determining the cost of capital in the economy. What is the inflation rate that's prevailing in the market, as well as the demand and supply of the source of capital. So those are all that comes under general economic conditions. Then the market condition, if we talk about market condition, so for example, the securities or the shares of a particular company which is readily available. Again here the demand and supply plays a major role. So for example, if the security may not be readily marketable when the investor wants to sell. So if there is the marketability of the security in the investment market, then automatically that determines the cost of capital. That particular company's security, whether it is readily marketable or not, whether the investor can able to buy and sell when and where it is required, then that also determines the cost of capital of a particular company. The firm's operating and financing decisions. So risk also results in the decision made within the company. So this is generally divided into two classes: business risk as well as financial risk. So in any companies, business risk will be there as well as financial risk will be there. Business risk means is nothing but it's the variability in returns on assets that affects the company's investment decision. So, what is the business risk level of a company affects the investment decision of the particular company, as well as the financial risk is nothing but it's the increased variability in returns to the common stockholders as a result of using debt and preferred capital. So the amount of financing that also plays a major role in determining the cost of capital. For example, whether if a company requires a huge fund, then they have to depend on or go for a different source of fund or different source of capital. They have to go for equity, preference, debt all together. So that may increase the cost of capital of a company. So the amount of finance that is required also plays a major role in determining the cost of capital. So these are all the four factors that determine the cost of capital of a company. So now let's talk about, as I told in the previous slides, like components of cost of capital comprises of cost of debt, cost of preference share, cost of retained earnings, as well as cost of equity, and all together we call it as what do you call it as a cost of debt. So now companies can raise debt by borrowing funds from financial institutions or from general public by issuing their debentures. So these are all the two ways through which a company can raise debt, either from the bank loan or by issuing debentures to the public. Then these are borrowed for a specific period of time and at a certain rate of interest. Here the rate of interest is fixed. The company knows that This is the interest that they are going to pay as a interest to the company, that is the banks from which they have borrowed the loan, as well as when they issue the debenture to the public as well as the other companies. They initially tell it this is the interest rate at which they are going to sell the debentures. So they may fix the interest. Fixed rate of interest is for both bank loan as well as what you call as the debentures. A debenture or bond may be issued at par or discount at premium. So, as I told in the previous sessions, a discount is at discount or premium or par. What it means is, see, each and every debenture, the company they fixes a face value. Face value is nothing but the price fixed by the company at the time of issuing. So that face value, it may be like the each debenture for each company it varies. For some company it may be 10 rupees, or some company it may be 100 or 1000 or 1 lakh. Even one debenture may cost around 1 lakh, 10 lakh. It depends. So that is the face value. Depending upon the demand and supply, company may issue the debenture at the same face value, whatever they fixed. That is nothing but issuing at par. When company issues less than the par value, so par value is nothing but other name of face value. When company issues less than the par value, we tell that the company have issued a discount. When the demand is more for the particular or debenture, then the company may issue a premium also. So they may sell at premium. So that is nothing but they can sell the debenture or bond either at par or at discount or at premium. The interest could be calculated on the par value or face value of the bond or debenture. So normally, generally, that is the procedure. Like even in case of in case of equity share and in equity share, the dividend rate is calculated based on the face value. So face value is nothing but the rate or the price the company have fixed for the equity share as well as the debenture. So the interest rate is calculated based on the face value or par value alone, not on the market value. So the debt may be redeemable and irredeemable. As I told, it may be a redeemable debenture or irredeemable debt. Redeemable debt means a definite period will be there, time duration will be there. So the company can use that capital during that period alone. For that, they can pay the interest to either a bank or a debenture. After that, it can be redeemed. In case of, for example, in case of what do you call the bank loan, the company may repay the the principal amount what they have received, and they'll close that bank account or a bank, what do you call it as the debt loan. So in case of irredeemable, what it means is once the money received from the banks or what do you call it as debentures, it will stay in the company throughout. Okay, they will not repay. They will not repay the principal amount. Only the interest will be paid. So here, how to calculate the cost of debt for irredeemable debt as well as redeemable debt. Okay, irredeemable, it's in the meaning itself that without maturity period, there is no definite maturity period. So how to calculate what you call it as the cost of debt is KD equal to interest divided by B0. So which means KD is nothing but the cost of debt. Okay, cost of debt, if you want to calculate for before tax, this is the formula through which we can calculate the cost of debt. And after tax, if you want to calculate KD multiplied with 1 minus T. T is tax rate. Okay, so this is the formula through which we can calculate the cost of debt for irredeemable debt. In case of redeemable, that is with maturity period, how to calculate cost of debt is before tax is nothing but KD equal to interest plus BN minus B0 whole divided by N, the whole divided by Bn plus B0 divided by 2. This is the formula through which we can calculate the cost of debt for the redeemable debt before tax. After tax, if you want to calculate the same KD multiplied with 1 minus T tax rate. So this is the formula through which we can calculate the cost of debt. And cost of preference share, if you want to calculate, again the cost of preference share is similar to what do you call it as it's again a fixed income security. Okay, so like for example, similar to the debenture, where the debenture or the debt, the interest rate is fixed. In the similar way here in cost of preference share, the preference share means what is as I explained in the previous sessions. So here it's a fixed dividend rate will be given to the investors. Whoever invests in the preference share will be getting fixed dividend rate that is known at the time of investment itself. So in preference capital, payment of dividend is not legally binding on the firm, and even if the dividends are paid, is not a charge on earnings, rather than it's a distribution or appropriation of earnings to preference shareholders.
So like as I explained in the previous sessions, they are not the legal owners. Equity shareholders are not the legal owners. So whatever, even though it is not what do you call it as legally binding, the dividend payment is not legally binding. Every company they pays the fixed dividend rate for preference share. And the cost of preference capital is a function of the dividend expected by the investors. Okay, so that is what the preference dividend, once if it invested by the investor, they expect a dividend. Even they have higher priority than equity shareholders. So that is why I have told that equity shareholders, they get whatever the leftover that is available in the company. So that is why they are called as owners of the residue or the legal owners, all those things. As cost of preference share, since it is a fixed dividend, it has to be paid prior to equity share. Then here the formula to calculate the redeemable, as well as here also the redeemable and irredeemable preference share. Again, irredeemable preference share, how to calculate is Kp equal to PDIV divided by P0, which means Kp is nothing but cost of preference share. PDIV means nothing but preference dividend divided by P0. P0 is nothing but what you called as the issue price or net value or the current value of the preference share. So that is the formula through which we can calculate the irredeemable preference share cost. Then redeemable preference share means with maturity period. How to calculate the cost of preference share is the Kp equal to preference dividend plus Pn minus P0 divided by n, the whole divided by Pn minus Pn plus P0 divided by 2. So this is the formula through which we can calculate the cost of preference share. Again here the explanation is given. PDAV means preference dividend. P0 means the issue price or net value or present value or the current market value of the preference share. KP means cost of preference share. That is what we are supposed to calculate. And N is number of years. So N is applicable only for redeemable preference share. In the same way, in case of debenture or debt, redeemable debt. Then PN means par value or maturity value or face value of that particular preference share. This is the formula through which we can calculate the cost of preference share.
So the next topic is cost of equity. So the funds required for a project may be raised by the issue of equity shares, which are permanent in nature. So like how the companies mobilize funds from debentures or like a preference share, the funds can also be mobilized from the equity. Again, this source of finance is permanent in nature, and the company need not repay those things during the lifetime of the organizations. And the calculation of cost of equity share is complicated because, debt and the preference share, it doesn't have any fixed rate of dividend or interest. So it differs every year depending upon the management's decision. Company takes they prescribe and give this year the shareholders may be given some 100% dividend or 50% dividend. So it's management decision. Every year it varies. That's why it's called as a variable income security. And the cost of equity share is considered by considering the earnings of the company, market value of the share, dividend per share, as well as the growth rate of dividend or earnings. So these are the factors that is taken into consideration while calculating the cost of equity share. So this cost of equity share is normally higher than the cost of preference share as well as what do you call it as the debenture or cost of debt we call it as. So it can be calculated using dividend growth model and as well as a CAPM model. So next thing is what is dividend growth model? So that's what we're planning to see now. Like an investor buys equity share of a particular company as he expects a return in the form of a dividend. So I've told in the previous sessions that when an investor buys equity share of a company, he expects two types of income. One in the form of a dividend and another in the form of a capital gain. That is when he sells, if he gets more than the purchase price, he will be getting the capital gain. So always the investors they buy the equity share with the aim of getting higher dividend from the company at the end of the year. So that is the return what we can get as a being the equity shareholder of a particular company. So the expected rate of dividend per share on the on the current market price per share is the cost of equity capital. So now how we can calculate cost of equity capital with the help of this dividend growth model? The formula is KE equal to dividend divided by price of the share plus growth rate of dividend. This is the formula D divided by P plus G. So what this D is nothing but dividend per share P is nothing but the current market price of share, and G is the growth rate of dividend. So this is the formula through which we can calculate the cost of equity using a dividend growth model. So now when we check about the sample problem or illustration problem, so the data given is like current market price of share is 90 and the expected dividend per share next year is 4.50. If the dividends are expected to grow at a constant rate of 8%, calculate the cost of equity using dividend growth model. So now as per this problem, the type of model which we are planning to use is given already. It's clearly mentioned as dividend growth model. And the next thing is what we are supposed to calculate. We have to calculate cost of equity. So which model we are supposed to use and what we are going to calculate. Both the things are given. The next thing is what are the data given in the problem. The current market price of share 90 is given. So which means P0, the current market price of share, that is P value is given as rupees 90. Then the expected dividend per share, that is D value is given 4.50. And the dividends are expected to grow at a constant rate of 8%, which means growth rate is given. Growth rate means that is G. G is given as 8%. So 8% is nothing but if we convert, that is nothing but 8 by 100, that is equal to 0.08. So we have to substitute all the values in the formula. Then KE equal to D divided by P plus G. So which means D means the dividend per share 4.50 divided by the price of the share 90 plus the growth rate of dividend, that is G is 0.08. So when we divide 4.5 divided by 90, we will be getting 0.05. So when we add that with 0.08, 0.05 plus 0.08, you will be getting 0.13. So that we have to show as a percentage because cost of capital is nothing but we need to show how much percentage. So that 0.13 is nothing but 13%. So cost of equity as per dividend growth model for this particular problem is 13%. Next is CAPM model. So again a very important model. CAPM is capital asset pricing model. So this model is like a more advanced one when compared to the dividend growth model. So this model is also used to calculate what you call as the cost of equity. So this considers the risk-free rate as well as what you call as the risk premium and what you call as the market return. All the values will be considered while calculating the cost of equity. So for example, in every security, risk will be there. So risk will be there as well as this has to be compared with the risk return, what you call as the market return as well as what is the risk premium. Because when someone takes a risk, the particular investor expects premium also from that investment. For example, let us take the general formula in financial management is the return. What is the return you can get is risk-free rate plus risk premium. So what, for example, if someone says, if some company says, or some what do you call it as investment, in some investment, if the risk-free rate is 9%, and if they say a duration of 3 years, which means for the duration of 3 years, we can get the risk-free rate of 10% from the particular investment. And suppose if the investor wants to take an extra risk of going with the fourth year also, then he is taking a risk. So which means he may expect the premium return also from the investment. So 10% plus some extra. So that is nothing but the return. The return always what you call as the investor expects when he takes a risk. Return equal to risk-free rate plus risk premium. The same formula is used here. So KE equal to RF plus RM minus RF into beta. So this RF is nothing but the risk-free rate. Okay, what the investor expects during the riskless period. And this RM minus RF into beta is nothing but the risk premium. So RM means the market return and RF means risk-free return and beta means nothing but it stands for the beta of a security. So beta of that particular company shares, that is beta. So the beta value measures the systematic risk of a particular security. So when beta increases, for example, if market beta is always 1, as we all know, already know. So when the particular shares return or the beta is 0.8, which means when market moves one time, the particular share or security also moves 0.810. That is the meaning of our relationship between the return as well as the beta. So beta plays a major role. Always the market return or the market value of the beta is always 1. So that is the base and with which we can compare with the other companies beta, and based on that we can decide how much return the company expects in ups and downs. So that is the relationship between return risk as well as the risk premium. And this model, CAPM model, capital asset pricing model, was developed by William Sharpe. So this Sharpe as well is a very popular person in case of the portfolio management. And then along with John Linter as well as Anne Mawson. So these are the persons who are what we call as they developed this model, CAPM model. And the CAPM model establishes the linear relationship between the required rate of return of a security and a systematic or undiversifiable risk of beta. This relationship is defined as or defined by CAPM and can be used to value a equity share. So this particular equation, RF or K equal to RF plus RM minus RF into beta, it gives a linear relationship between risk-free return, then what calls the market return, as well as the beta of a particular security. So and this that is what given in the below. Risk premium is to compensate them for the additional risk assumed in investing in a risky asset. That is the required rate of return equal to risk-free rate plus risk premium. So that is what the investors expects or the companies expects from the investments. That is CAPM model.